because right now we're also in a period where we know the reason why fixed rates are inflated. Like they're inflated because of oil.
Yeah, yeah.
They're inflated because of the conflict and the Strait of Hormuz being closed.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name, Paul Stevenson. I'm a Level 2 mortgage agent. I'm joined by David Warren, Level 2 mortgage agent and owner at Referral Mortgages. We want to say thank you to everyone who's listening. Every Wednesday, 10 a.m., we release new shows. Make sure to follow us, subscribe, leave a comment, and a quick thank you as well to our amazing sponsors. David, it's May 26th. Spring market is in full bloom. The hot weather's finally here. How are you doing? What's going on?
Doing well. Yeah, got away after the show last week. Was in Toronto for the mortgage awards.
Yeah.
There with, it's kind of the national mortgage awards for anyone in any brokerage or network or anything like that. So it was good to see a number of people, and then meeting with some lenders on the following day, since I was in Toronto anyways. So it was good to kind of catch up with some people and kind of hear what others are seeing across the country, which is a lot of the same of what we're seeing here, kind of speckled busyness to mostly slow. But yeah, I mean, really kind of, I know this past week we've, you and I have at least seen purchase pick up. We were talking off air, whether that is like kind of the norm across the board. So we kind of, looking to touch with other agents and find out whether they're seeing the same. But yeah, how about yourself?
Yeah, I mean, this kind of happens every season. Like, I feel like from January to March, there's a lot of conversations happening, people kind of prepping for the spring. And then there's kind of a lull between like March and May where you kind of feel like, oh, well, like, were these people just kind of kicking tires? Like, is nobody actually really out buying? Is this just all, just like fake interest in the market?
Mm-hmm.
And then there's 1 week or 2 weeks where the boot drops and everyone buys homes, and it's just like, it feels like it happens overnight, but it doesn't. It's like a 4 or 5 month cycle, but it feels to us like it just happens all in like 5 days. And like, you talk to people and like, wow, how'd you get all these files within a short time frame? Well, it's not. It's been like 6 months building up to this. It's just they all happen to happen at once, and it feels a bit overwhelming in the time, but ultimately it's just the spring market. And I think in reviewing my active files currently, a lot of the people that are buying now are people that are relocating from other areas in the country. So the kind of relocation season for our Canadian Armed Forces is typically kind of between that like April to August timeframe. And anyone who's worked with CAF members, that they always have kind of like, they get their ducks in a row. They're always very organized, very professional. They have their home hunting tour. They come for 5 days. They look at 100 homes, and then they, really quickly buy something, and it's just like, it's every year. Like it's urgency. They have to do it. Our armed forces actually have a lot of their like moving costs, relocation costs covered. So there's not as much fear about closing costs or penalties on their existing home or anything. So it's just like, there's less barriers. And I find that it's just, they come, they see, they conquer, they leave. It's like in and out. And that happens every spring. And it seems like this is that time now. There's, a lot of my clients are relocating, our military members, and they all are here over the last couple of weeks. And a lot of them have bought homes in the last, 14 days.
Yeah, it's kind of a lot of the postings are, when they're posted somewhere, it's like a 3-year interval. They're a lot of times posted somewhere for 3 years. So they're buying and moving, every few years. So they're very, a lot of them that have been in it for a while, they're used to the cycle of kind of what's needed. So to your point, kind of very organized. I worked with somebody this past week where, I helped them 3 years ago. They relocated from Italy with D&D, with the military to Ottawa. And now Ottawa, they're moving north to the territories. And so kind of helping them with that as well. And it's kind of that same thing, like very organized, drop in, here's like the list of homes. And it's, kind of, just really kind of like which is, always nice as well at the same time, but it is kind of that house hunting season. So, when I say that last week of speaking to others across the country of what they deal with, and we just have a lot of military in and around the Ottawa region. So this time frame for what we go through is very, we talk about different areas being, in different cities being very different from one another when we're talking about statistics, when we're talking about pricing, when we're talking about sales activity or anything like that. Every city has the little nuances, and for Ottawa and the Valley, it like D&D or military relocations is just one of those. We just have so many postings in and around Ottawa, written and around Ottawa that they don't see in a lot of other places around the country.
Yeah, and I think it's just like you said, their experience. They've probably, I mean, they relocate often, so it's not like this is, with most clients, they're buying a home maybe every 10 years or 12 years, 15 years. But in this case, they might be buying a home every 2 or 3 years. So it's like they're a lot more familiar with the process. They're a lot. I find them a lot more. I don't want to say easygoing because that's not the right term, but they're receptive to advice, and they're just like, tell me what to do. I just find they're down to business. It's like, okay, we got to find a
Mhm.
home. We have a 7-day window. Let's get it done. It's like very like black and white, which I don't mind. I kind of like that sort of approach, just because the conversations are a lot more direct, and I just feel like they come with a purpose. They know exactly what they're looking for, and they find it and they move on, and ultimately that is, I think, why also the days on market that we're seeing. We were talking about how it's been 21 days kind of, from March to April, which was surprising. And I talked to a few realtors about that, and a lot of them did feel that that was a direct result of the, delisting and relisting, kind of taking it down, reposting it, and the fact that that restarts that cycle. We talked about that last week, that is kind of skewing the numbers. And I think a lot of people were surprised to hear that. Like, they didn't know that that was something that actually happened.
Mhm.
So, when you see
Yeah.
21 days on market, that home could have been listed for a total of 120 days, but it's only been 21 days this time. Like, they might have been 100 days.
Mhm.
They took it off for a week and put it back up, and now it's been 21 days. So it is a bit misleading.
The only caveat to that is that that's that affects all stats. So
Mhm.
even when the days on market are high, properties are still sitting and coming down. I think where that shows of the delisting and relisting activity of that shortened timeline is that people are more receptive to the requirement to lower their price. That they're not sitting with it for as long. So when we're seeing the longer days on market, not only are properties sitting longer, but they're also not as apt to lowering their price because this is what they need, and they're not willing to budge on that price because that's what they could have got last year, 2 years ago at the time. Really, we're talking more 2 years ago now pricing. But I think now people have come when we're seeing that days on market shorten. It's a lot of that is people are realizing that that's not the price they're getting. We need to move. We need to, like we talked about that people are moving for necessity and not out of like desire. And so, it's a property that's up for maturity. They're like, I want to sell it before it matures so I don't get hit with massive penalties. So they're lowering that price just to unload it, or they have to move because of a relocation or whatever it may be. But there's, they're reducing that price. So they're delisting and relisting it quicker, where I think that they're more understanding of the market more. Like it's not something new where they still think they could get, you know, 2022, 2021 pricing.
Right, right. And I think that's kind of the, I mean, it everything kind of levels out eventually. Like, we were talking probably 2 months ago now that people were realtors were suggesting a price, and people listing sellers were kind of adamant about listing it higher than what was recommended, just because they had that idea of, well, this is, it sold for this exact same amount in the fall. It has to be more now, just that
Mhm.
kind of, it was a bit of a resistance to listing it at the suggested price. Now I think after the home sits for 40 days, 50 days and doesn't sell, then it's kind of like, okay, well, let's readjust. So now I think we're seeing the readjusted prices of all those listings that
Mhm.
were out in March and April, which are now starting to churn because of the fact that they've been readjusted to the correct market value. Something else that I'm having a lot of conversations about lately, Dave, and I'm sure you're seeing it too, is a lot of people now are inquiring and are willing to take on the risk of a variable rate. Over the last 3, 4 years, probably 5 years, the variable rates have been either at par or higher than the fixed rate. So people were just thinking, like, why would I do that? Why would I expose myself to potential further rate risk if it's at an even higher interest rate? But now we're seeing the variable rates, especially right now where we saw the bonds climb. And I know you wanted to touch on, like, they have readjusted now. They've come down a lot in the last couple days with the oil prices. But more people asking about variable. We're looking at, in the best of cases, insured variable rates are in the like mid threes, whereas the fixed rates are still in the, 4.25. So you're talking in some cases almost a 3/4 point like difference between a variable rate and a fixed rate. And people are just, the writing's on the wall. Like, why would I take that higher rate with all the flexibility of a variable? Now, obviously there's risks involved and so on, but more so, I guess I'm saying this because people are actively requesting variable, whereas that really, like, we
Mhm.
were talking probably a 95 plus percentile that we're taking fixed for a good 2 years, and now we're in a place where it's probably, I'd say, 50-50, or maybe even higher percentage of people are wanting to take variable because of that savings that's there right now.
Yeah, I think the stat is around 70% right now are taking variable. But yeah, anytime that there's a delta between the discounted variable rate and a fixed rate, it's kind of always that threshold that I always speak to clients about. If the fixed rate is higher than 50 basis points, so half a percent higher than the variable rate, then there's a discussion we had that variable might be the better way to go. And the reason for that is typically and historically, we did see obviously coming out of COVID, we saw some massive jumps in bank prime, which was extremely abnormal as far as like it going half a point at a time and things like that. As far as increases, historically, it's been quarter points at a time. And so whenever I'm looking at a variable rate in the mid threes, and right now most insured 5-year fixed rates are in the 4.39, 4.49 range, you've got a very large delta. Like we're 0.75% to almost a full percent in some cases, depending on the lender, as far as differences between variable and fixed, which is a massive delta between them. So what you would need is, and the reason why I use half a percent is you effectively would need bank prime to increase 2 times in order to equal what that fixed rate would be. So if your discounted rate on variable is 3.6%, and you're at, 4.39, you're
Mhm.
needing 3 increases in bank prime to equal that out. So, really over that period of time, you're getting that cost savings in your payments, you're getting that cost savings in your interest savings, paying off more principal. And you're going to need those consecutive increases to equal it, which obviously takes time. There's no writing on the wall that that's going to happen because right now we're in a period where we know the reason why fixed rates are inflated. Like they're inflated because of oil.
Yeah, yeah.
They're inflated because of the conflict and the Strait of Hormuz being closed. That's why fixed rates and the bond rates are up where they're at. And so really when we're looking at that, people are saying like, well, why am I going to lock in on a fixed rate when this is hopefully temporary and that the strait is going to open up at some point and we're going to have bonds, come back down, which at that point, when a variable rate, I can convert and lock into a fixed rate at that time. And you're showing a great chart that, over the last 5 days since we recorded, we're down, what is that, quarter point?
Mhm.
And really
Almost a
kind
full
of,
quarter point. Yeah.
yeah, I mean, really with that, that's completely telling because we've seen oil drop from $115 a barrel to $91 a barrel. And so really it is, that movement in oil affects the bond market, which is the fixed rate. So they're not artificially inflated, but they're inflated due to where crude prices are at, directly affecting bonds. So a lot of people in the conversations, they're gearing towards variable for that reason, and that they can convert to fixed at any time. So they have that flexibility, or that they are like, you know what, it's a renewal I have up on a rental or on my primary residence. I don't know what I'm going to do over the next couple of years, or a rental where they're like, I'm going to be eating it temporarily because it is up from what I was paying in 2021, and I don't know when I can sell or when I'm going to sell, and so I'm just going to take variable to minimize my penalties.
Yeah, and I would say I was expecting more conversations about restructuring on renewal. I would say it's actually the opposite. Like in the last 2 weeks, I've had more conversations about people asking about shortening their amortization or making a lump sum on renewal, or like basically like they want to pay it off as fast as possible. I think that is also a result of people seeing the higher interest rates and saying like, listen, we don't want to pay that much interest. There's always two types of clients, right? There's people that want the minimum payment, the highest cash flow, just so that they have more cash in their pocket. And then you have the other client that wants to pay off this mortgage as quickly as possible. They want it done yesterday. And they have two totally different approaches to how they approach their renewals. But I think the latter is more of the conversations I'm having, of people wanting to know how to Like, what are my prepayment options? How can we lower this at renewal? How can we shave off years of the amortization? Like, people are actually asking those questions, which that's not common for people to be asking that at renewal. It's usually like, okay, we have some debts to pay off. We need to restructure this. We need to lower our payments. And with the rising rates from where they were 5 years ago, 3 years ago, I'm surprised to hear that the conversations are shifting more towards how can we pay this off sooner than how can we readjust to, restructure our finances to make it more affordable. Now, I don't know if that is a national, like, I don't know if that's common, if that's like, just specific to this market, or even just a small subsect of my clients right now at this, short time frame and just coincidence. But I'd be interested to know if you're having similar conversations, or like what are your renewal conversations right now, and like where are people leaning as far as restructuring their products. Even the best photographer can't hide drywall dust and paint splatter. And every day you delay listing could mean missing peak spring pricing in Ottawa. A to Z Cleaning Expert gets your property truly photo ready. Don't risk going to market half ready. Mention TOREP at a2zcleaningexpert.com to receive priority scheduling for your next listing. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca.
I find it's a 50-50. People renewing dollar for dollar, looking to maintain the same amortization schedule, and then the other half looking to consolidate some debt. I would say it's really right down the middle. However, there was, to your question and comment, a really good figure in the real estate world that we both follow, Daniel Folk. He spoke about a CMHC article where they released data that kind of that renewal cliff they were expecting is not coming to come into fruition, or hasn't come to fruition. It's actually, the number of people having issues with their payments or with those renewal shock is actually, I think it's in like they went from like basically in the 90th, they were looking at like 90th percentile to now being like around the 20% on their polling, is that of expectation of shock, and as well that they're not going to be able to maintain their payments has dropped dramatically as well from the last time they polled. It's last year, I think it was around the 45% range. People polled saying that they weren't sure how on renewal they were going to make that payment, to being less than 20% in 1 year saying at renewal, I'm not up yet, but I don't know how I'm going to make that payment. So that's a massive drop from like in 1 year in that CMHC polling, which I think is, to your point, is also an interesting one, because it basically is kind of the indicative of the overall market. I think people are realizing, and probably some of those numbers is that they're having earlier conversations and realizing that, okay, well, maybe like I actually, even if my property hasn't really gone in value, or maybe it dropped a little bit, but how much I've paid off in principal because of the low interest rate that I had, that, really my change in rate, I can change my amortization. I can play with that. That, like in a lot of cases, when I'm having to do that, I'm keeping the payments the same. Like when I speak to clients, like one of the first things I'm asking is, are you renewing dollar for dollar? Great. What's your budget for payment? Because then we can play with that amortization to see whether we fit that budget. And I think to that CMHC poll is a lot of people having those early conversations 6 months out, like we've kind of talked about, and people realizing that, hey, I know I can like play with that amortization, or I know rates aren't in the 6% like they were 2 years ago, and my payment isn't going to actually change. My amortization might change a little bit, but I'm not going to have any payment shock to what everyone was expecting. I thought obviously it was a little far fetched that there would be this like cliff, if you will, knowing like
Hmm.
being in the industry and knowing that we can change the amortization and with mortgages. So I think kind of, there was a comment in last year's episode of there's going to be a lot of people experiencing renewals at a loss for the next 18 months. We've seen the predominant portion of mortgage renewals is happening right now and happening through 2026, and these conversations and rates are already locked in right now into September, and there's not a cliff of payments that people are having to endure. And so the commenter was saying it'll only get worse from here, from January to April. You'll be flabbergasted by losses you guys will have to deal with if your banks won't renew a higher percentage of these deals come January 2027. I don't believe that at all. The banks can't endure those losses. And as well, why wouldn't, like, if somebody is insured by CMHC, Sagen, or Canada Guarantee, the mortgage is backed. They're renewing it and it's an insured mortgage. They don't even they have, no risk. They have little to no risk on that mortgage. So even if the property value is dipped a bit because somebody bought with 5% down, even if it's above 100%, like they're still back end insured for that, on that mortgage, the predominant portion of that mortgage. If they bought with 20% down and the value dipped a bit, well, they've paid down over 5 years that principal. So,
Couple things I wanted to note on that. All very good points. And we do see a very wide spectrum. Like you were talking about a client you had, before we came on air that's, in the territories up north. And like, we have clients that are out in BC and out east. We talk primarily based on the Ottawa market, which is where the majority of our clients are. But it's also important for everyone to understand that like this is like Ottawa is a very unique market. Like we were just talking about even just like the relocation migration to Ottawa or to the surrounding areas. Places like, out in Manitoba or areas of BC where they're seeing massive losses, massive reductions in values. Like that is not Ottawa. And obviously Canada is so like parceled that you can go from one town to the next and one town could be booming and the next, prices are plummeting. Like it's just, there's so much nuance to the Canadian real estate market that it's really hard to just brush the whole country with a single stroke. It's impossible because literally, like I said, like I'm in Carleton Place to Ottawa, totally different markets. You go Ottawa to Rockland, totally different markets. Ottawa to Montreal, you go further, different markets. Ottawa to Toronto, like the further and further you go out, the more and more nuanced it is. But going back to the rate conversation, this is actually one of the few times that I can remember where I actually have clients considering that we're planning to put 20% down and are looking, million plus purchase. So they're looking at, a 25-year, let's say, higher 4 percentile just because it was uninsurable at the time, given the price and their current situation. Or because of the new CMHC rules, they could put 19.9% down, get a rate that's literally a 0.5% lower on the insured, and then just make prepayments. So like we've been doing the math, and there's some cases where it actually made sense to put less down payment, get a better rate because they were saving so much on payments and interest on that loan. And they knew that they could just make additional prepayments on top of that anyways to basically pay it down faster. So that's never happened. Like I've had clients ask that. And in my, 14, 15 years of doing this, it never made sense to put less down payment and pay the insurance premium. This is one of the few times where the like uninsured in quotes rates are so much higher than the insured rates. And again, this is obviously inflated because of the oil and everything else. And I think it will adjust, but I've never seen that before where it has made sense in select cases to put, a 10,000 less as a down payment and get an interest rate that's a 0.5% lower, you know?
Mhm.
So I just thought that was
Yeah,
different. It came to mind when you were talking about that, and that's never happened. So like definitely an anomaly right now.
it's the maths.
Yeah, it's
I
got a
I
math.
kind of use the adage all the time, like numbers are numbers and numbers are what makes sense. And so like diving into those numbers, in a lot of cases, like you said, paying that insurance premium is, in 99.9% of cases historically has been, it doesn't make sense. But when you have a delta like that, it's pretty easy to catch up that mortgage premium on a larger loan amount as well. But no, it's certainly interesting. Really to that as well as like those home buyers, make sure to have that conversation as well and look at those figures and not, I was speaking with one of our agents last week. They were looking at just the payments, the month to month payment amount difference on rates. And I had to explain to them, have the conversation with them that there's 3 components to every rate. There's what you pay monthly on your actual payment, how much goes to interest, how much goes to principal. It's 3 components. So you got to take that all into account and factor what's the difference between the payments I'm paying, what's the difference in interest savings, and how much extra principal am I paying off over that same term or period. And those 2 components of interest and principal get forgotten about. Everyone just looks at that payment amount, which is not, there's cost savings in that. But once you actually break out the interest and once you break out the principal, it becomes abundantly clear in a lot of cases of what that difference becomes in cases, tens of thousands of savings.
Yeah, I mean, there's some cases where I'll tell a client like, oh, you're going to save, $150 in payments plus whatever else in interest. And they're like, oh, 150, that's decent. Well, no, that's, it's like $10,000 over 5 years. Like it adds up really quickly. You know what I mean? So there's a lot of times where we have to actually show those breakdowns. And then that's always, and I know you do the same thing. It's like, here's option 1, here's the payment. Here's your total principal paid over 5 years. Here's your total interest paid over 5 years. Here's the principal balance after that term. And then here's option 2, and breaking it down so they can actually see like, here's your payment savings, simple math. Here's your interest savings, simple math. And here's the balance. And then let them make an informed decision from there,
Yeah, I mean, really, again, it just kind of comes down to breaking out the numbers, breaking out the math on it, and not being, kind of surface level on it is what we always like to say.
I don't know how we did it, but we somehow got through a full episode without much negativity. Like I'd say that was pretty much mostly positive. That's good for us. That's good. That means the market's hot. Hey, time to pump.
Maybe
It's time to pump.
we're turning a new leaf. I don't know.
No.
Oil prices are still high. The strait's not open. Rates are still inflated.
Spring has sprung. We're here. Dave, should we slide into the mood boost? Close on another high here.
Let's do it.
So I got 3 today. And I think they're pretty good. Not as good as last week, but they're up there. Number 1, what do you call lonely cheese? Provolone. Provolone.
Okay.
Yeah, the loneliest of cheeses. Number 2, why would doors do well on social media? Everyone's always looking for their handles. Very popular. Handle guys. And last but not least, some mornings I wake up grumpy. On others, I let her sleep in. Boy, I'll get some hate for that one. Hey, I didn't write it. Thank you, everyone, for tuning in. The Ottawa Real Estate Podcast. We're here every Wednesday, 10 a.m. And we want to say thank you to our amazing sponsors. Thank you to you for listening, watching. And we'll be back next week. Have an awesome week. We'll see you soon.
Deuces.